The Fed concludes its two-day policy meeting today and is likely to signal to the markets that it's thinking about changing its bond buying policy. With us now to discuss possible market reactions, Ryan Detrick, senior market strategist at LPL Financial Research, and Krishna Memani. He is chief investment officer for Lafayette College Endowment. Good morning to you both. Guys, Krishna, let me just start with you here to handicap what we might hear, what the market is expecting, and how it might react. I mean, obviously, you know, Jay Powell can continue to say we've continued to monitor the progress toward our goals on inflation and employment. We're not there yet. Therefore, status quo is possible. But you have to acknowledge these inflationary surges recently, don't you?
Yeah. So I think the core message from the Fed is not likely to change. That is, they are still on hold, and they will wait a long time before they do anything substantial. Having said that, I think marking things up to market with respect to what has happened in the economy, both from a growth and inflation perspective, is something that they will have to do. Otherwise, they kind of lose their credibility. So I think that is one thing that is going to happen. Second, there is a potential that some of the liftoff talk gets moved up a bit. But if that happens, I expect Powell to talk about it quite aggressively in his press conference. And finally, as far as a taper is concerned, which is probably the most concrete action they can take in the near term, I think they will still dodge the issue because they don't really gain anything by doing that just yet. They just will have to wait and see how the next few months play out before they actually do something about taper. So right now they will just be talking about tapering.
Yeah, and maybe starting the clock implicitly. Who knows? Ryan, talk about the market setup here. Obviously, market's been kind of steady, holding pretty good gains, but you've seen a little bit of the fever break in terms of inflationary indicators and things like that.
That's right, Mike. You know, Dom just mentioned, transports are weak, consumer discretionary is weak. Yet, if you look at the S&P, we're flirting with all-time highs. Think about this. I mean, we're all excited about the Fed meeting, and it's a very big deal, but I totally agree. I think it's going to be a non-event. I think when we open tomorrow's newspaper, we're going to look more at how Putin and Biden shook hands and looked at each other versus what the Fed said, because they've telegraphed it. But we've gone 17 days in a row, Mike, with the S&P 500 trading within a 1% range. That's one of the longest streaks we've ever seen, one of the longest we've seen since late 2019. What does that mean? Well, listen, things are non-volatile, and now the Fed's coming up. Historically, the second half of June is one of the weaker periods of the year. I know seasonality doesn't always work, but just kind of be aware of these things. After this big rally, we haven't had a 5% correction, Mike, in the S&P since September. All right, that's one of the longest streaks we've ever had. So it can keep going, yes, but the thing we've been saying to our more than 18,000 advisors, after this huge rally, we think some consolidation, some sideways action, heaven forbid, a 10% correction, we don't think much more than that over these troublesome summer months is perfectly normal. And that's kind of how we see things. The baton is getting passed around. I mean, now energy and certain groups are leading, but that's a sign of a healthy bull market.
Shepard Smith here. Thanks for watching CNBC on YouTube.